Ladies and gentlemen, boys and girls, welcome to the Fintech Frenzy. Today, we have a shorter show, but that doesn't mean that we don't have any news today. There are some fun stuff that I want to cover and talk about. And what a freaking red day it was. According to this news article that I'm reading right now, S&P 500 largest one-day pullback since 2022. Holy. Tesla got an absolute schlacking over the last 2 days. And it's absolutely wild to watch. But we're going to keep it mainly focused on the fintech side, which there still are some pretty, bloodbath names in the sector. I can just bring up some for you guys to see here. Bear with me a moment. There you go. So Affirm almost down 10%, Upstart down 9.5%, Toast down 8.3%, Block down nearly 8%, like just an absolute bloodbath. SoFi down 4.4%, nearly breaking below $6 again. Who's buying though if we break below $7? You thought it was going to break 6? under 7. Like, so are you buying it at $6.99? You know, like at what point do you start repurchasing to try to buy back? Is this drawdown big enough just in the last 5 days, down 9.44%? Is that enough for you boys and girls? Can't forget the 4 women that watch this show. Adnan, how's it going? Jay, good to see you. Captain Crunch, he's calling for 6 tomorrow. All right. 550 is my buy zone. Don't think it gets there. Okay, so you have a pretty big position already, B-dubs. You're not looking to buy in a little bit more. I'd say probably my buy zone right now, it's somewhere in the 6s. Somewhere in the 6s for sure. All right. Let's get on to some of the news though, because I got quite the show. So, Marqeta, this is important, okay? Although I'm not going to be talking about their stock necessarily. This is a Galileo direct competitor. In fact, just to tell you about the size of this business, they run card programs, have credit cards, all these sort of things. Their largest client is actually Cash App. So all of the many tens of millions of users that have the Cash App card are actually, those cards are being sent out and approved to by Marqeta through the Marqeta dashboard. So they're pretty interesting in the fintech space. They go after all of the exact same clients as Galileo. They're a fierce competitor. Okay, they have Coinbase, they have Uber, they have a lot of the big tech names, DoorDash. They actually run the program for JP Morgan's virtual cards. So they got some big names. That's not exactly what I'm talking about here, though, today. One of the things that I love about Marqeta, however, is that they team up with a lot of research companies and sort of try to understand the environment that we are in the fintech space. Okay, they do this for their B2B clients, they do this for their investors, and it's a wealth of knowledge. Now, if anyone is a buyer of my course, you'll know that the State of Payments report in 2023 was an amazing report. I drooled over that report because there were a lot of great things showing the momentum or the total addressable market growth for fintech in general and in payments. Well, they finally just released the State of Payments report for 2024. Finally. So we can get sort of a first glimpse at, how fintechs and everything have been doing over this time, and yeah, just get a quick little peek. I've gone through already and highlighted a bunch of things, but we're going to go through it pretty quickly just because I don't want to dwell on each individual thing. But yeah. So I don't actually know if I'm going to keep it like this or if I'm going to zoom it in. However, here, wait one sec. I am going to represent it. I just full screen might actually be. Yeah, I want to be able to have a little flexibility for you guys. Okay. A couple things. In the 2024 State of Payments report, Marqeta partnered with a third-party research partner to understand consumer payment trends and preferences. Things like contactless payments, digital banking, and non-traditional finance services continued to grow momentum over time. Well, let's see. There's a rising demand, especially in the Gen Z and millennial stuff, for cutting-edge banking services and enabled finance offerings. They're going to get into some actual statistics. This is just a quick little introductions of how they did this report and what we're going to see here. They surveyed 4,000 consumers age 18 and above across 3 countries. 2,000 people in the US, 1,000 in Australia, and 1,000 in the UK. For the most part, I've highlighted stuff from the United States. There were a couple very interesting standout points from other geographies because we do follow companies like PayPal, for example, that function in all of these geographies. But with SoFi, with a lot of these ones, it's all US based. I wish they included some Latin America as well, but we don't get to see that. Okay, so first off, and also I saw a couple inconsistencies here, and I'll point those out as we get along. But the US seems to use them, or sorry, consumers' preference for frictionless integrations of their personal and financial lives is driving the adoption of embedded finance. Okay, so things like contactless payments, mobile banking, buy now, pay later. These are the things that traditional banks are having a hard time with, but consumers may end up wanting. Anyway, one of the things that they said here, they said the US seems to like them less frequently, likely due to a lack of merchant acceptance and the difference in transportation behavior at present. On the other side, the US also possesses a strong uptake rate of digital-only banks in peer-to-peer transaction platforms like, Cash App, Venmo, Zelle, right? Now, they said similarly, about half, 57%, said that they've used a mobile wallet in the last, I think they meant 90 days, because everything that they're doing is talking about last 90 days. They put 990 days, little typo, compared to 58% in the UK and 55% in Australia. This indicates further addressable opportunities in the United States. So this was the only spelling problem that I found with this whole report, but I think they did it twice. They said about half, 57%. I actually think they meant to put 47%. And the reason why is anytime that in the rest of this report that they write over 50%, they say over half or more than half. They said about half, and then they said, the other comparables are 58% and 55%. So America has a long runway to go. Well, no, it doesn't. It has 1% to get to the UK, and it's already bigger than Australia. So that doesn't make any sense. I think what they meant was 47%. I could be wrong. But still shows the fast adoption of mobile wallets in general. So consumers across geographies are increasingly embracing the idea of a cashless society. I was on the phone yesterday with Stephen Fiorillo talking about how I'm a big believer in this cashless society. And he completely was bashing me, tearing me apart, saying, cash is very useful. You got to have it. You don't want the government to have too much power, all this stuff. Anyway, the important thing for me, guys, and you're going to see this with this entire report, I'm only giving you the perspective of a young individual whenever I say those sort of things, or at least one individual. I'm not speaking for my whole demographic, but as we go through this report, the more people that are willing to adopt the more innovative or sort of cashless products are the younger generation. Anyway, now they talk about accelerated wage access a couple of times. This is kind of funny because we were talking about how this might get completely redone, and the money that they can make on this might actually get sort of killed if they start getting treated like a consumer lending product. All right. Consumers are more comfortable leaving their wallets at home. The growing acceptance of cashless methods means more consumers are leaving their wallets at home in favor of paying with their smartphones. A whopping 96% of consumers have at least one card in their mobile wallet, and well over half, 62% of them, feel confident enough to leave their physical wallets at home, a figure that jumps up to 67% amongst people who are aged 18 to 25%. You see? Now, it's not even 62% because this is the full market. They're including the 18 to 25 range here. So it's actually a pretty big gap that the younger generation has in terms of leaving their wallet at home. I told this to Steve yesterday. I said the only thing that is stopping me from leaving my wallet at home would be my freaking identification, like my driver's license. The second that they can allow me to put this on Apple Pay or Google Wallet or whatever, I am not carrying around a wallet. I have $0 in cash in my wallet right now. Some will call that silly. I've never ran into an issue. Not once. Okay? But yeah. Well, sorry, what else did I read here? Well, 60% of consumers reported using cash in the last week. Nearly 3 in 4, 71% of U.S. consumer surveys expressed that they weren't concerned about moving to a cashless society. 71%. Tell that to Steve. Okay. More than a quarter, 28% of respondents say they feel awkward when paying with cash. Now, feeling awkward is a weird term here. I wouldn't necessarily say I feel awkward doing that, but I hate doing it. I feel like I'm getting taxed because the freaking coins that they give me back or something like this, I don't want to carry around. So I just end up tipping it or donating it every time because I'm not, like, I don't know. Maybe I'm a weirdo, but at least I've got a good 28% of people that also agree with me. Consumers 18 to 34 years old were especially prone to those feelings. Nearly half, 49%, say that they paying with cash made them uncomfortable. Like I said, I don't know if I fall into this vein, but this is where, like, the reason why we're reading this report and the reason why I think that this is so important is that this is how the companies that we're betting on in the fintech frenzy essentially grow over time. The younger generations want to have services that I am investing in. Cash App, Robinhood, SoFi, PayPal. These are all beneficial. And in fact, as we go through the report, they're also going to bring up how this compares to their previous reports and how, I'll just give it a quick spoil, they're all accelerating in terms of how fast people are adapting to cashless societies, more onto mobile wallets, more through digital banking and everything. There we go. In the 2023 State of Payments survey, just over 1/3, 35% of consumers reported using less cash than the previous year, a number that has increased to 37% in 2024. So here's a good little thing over time. Now, this is broken down on the bottom by geography, the first one being the total US, UK, Australia. But the cash usage that increased was anywhere between 13 to 17%, on average 15%. Decreased, however, was anywhere from 31 to 50% decrease in cash usage. Holy crap. That was in a single year, ladies and gentlemen. A single year. I think that's pretty important. Let's field a couple questions, by the way. I think I saw Tavis here. He said, bro, 28% of Gen Z feels awkward literally talking to a human. I don't think the number's that high, but I do think that the number of introverts is definitely growing. Okay, I didn't really have anything there. Consumers are torn between loyalty to traditional financial service providers and digital curiosity. Just 18% of US consumers surveyed said that they'd be considered moving all of their banking to a digital only option. However, more than 3 in 4, 78% said they at least use one additional financial provider outside of their primary bank. Non-traditional financial service providers, including tech companies, social media platforms, and retailers, are appealing to US customers, with 42% saying that they would get financial services from one of these providers. That number ballooned to 63% of US consumers between the ages of 18 and 34. Now, I think that this is very interesting. SoFi, Galileo, Marqeta, whatever you want to say, will be a benefactor of even these non-traditional plays, but another one still will be those tech companies. I'm not anti any other sector, right? I'm all in on tech, and another reason why I'm a big believer in companies like the big tech platforms and these sort of things is that financials is one of those areas that they will continue to go down. Loyalty to tradition persists. More than half, 64%, have used their primary bank for 6 or more years. However, 1/3, 34% of consumers use a digital-only bank in addition to their primary bank. You can see the total here. Some people have been with their primary bank for 10 plus years. But in the United States, you'll see a lot of people have switched in the last, anywhere from 0 to 5 years. Excuse me. I'm about to sneeze. I thought I was going to. I feel like I'm losing it now. Anyway. Nearly all consumers feel that their primary bank offers all of the functionality that they need. Yet almost half, 46% of consumers have already changed their primary bank. And an additional 17% are continuously doing so. So I love this. This is so interesting. I didn't highlight this, but I should have. So if the data shows that people are generally happy with their primary banks, then why are they looking to change banks? If I could say anything to add on to this report, it would be this very important point, which is people don't necessarily know what they're even missing just yet. Of course, JP Morgan or TD Bank is going to have all of the necessary banking tools that you think that they can offer until they start doing credit monitoring. And then you're like, wow, that's such a great addition. Until they start increasing, the amount of APY. And then you go, wow, that's such a great addition. I never would have thought that a checking account could give me 5% and I don't have to pay account fees, right? So whenever looking at your traditional bank, do they offer what the other banks or other fintechs may be offering? And I mean, yes, to some degree, they are satisfying that need, okay? Until those fintechs come along and create new products that may be that offering that makes you switch. So the one thing I'll say with these reports, they always say, 90 plus percent of people are not willing to change, right? And then you see that they end up changing regardless. Like, I'll give you the best example. And this is the one thing that I find is so funny. You have to really try not to look at these surveys so often and trust in your ability to understand what SoFi is offering or what any sort of company is offering. And I'll give you one example here. My brother is not a redneck. I don't want to say redneck, but he's just a very, like a man's man, He's a plumber. He's a man, he drives trucks. It's stuff like this. He was so against electric vehicles. They were pussy cars or whatever the heck that he will say or something like this. Until that Cybertruck got released. And then he goes, oh, well, that's the next car that I'm going to be buying. Right? EVs, whenever they first came out, was like marketed to, is tree huggers a derogatory term? I don't know. Anyway, like more green loving Prius type vehicles that he was like, that looks ugly and doesn't represent the person that I feel like I am. And then whenever a cool bulletproof truck comes out that can help him with his work and do the length and have the speed and everything like this that fully fits the vision or the person that he aspires or is, right? And so I think getting a survey of saying, hey, in the future, will you be getting an EV? My brother would have wrote no. In the future, will my brother be getting an EV? 100%. 100%. Let's get back to it. So in this report, I believe that a ton of people are going to say, no, of course I'm not going to need to switch banks. My bank has everything I need, until a bank offers you a solution that you didn't even know you needed. Like, a shopping tab within your bank that offers you 3% cash back on everything that you buy through there. And they have every single thing, at higher benefits, lower costs. They're not sort of gouging your eyes out for overdraft fees or anything like this. It's like, of course, you are going to end up choosing that new offering. And that's what, the companies that I invest in, I hope that they end up doing. Anyway, customers tend to be very sticky when it comes to core banking services such as checking, savings, debit cards, and mortgages. That stickiness stops, however, whenever searching for credit cards and peer-to-peer payment options. Now, I think that these are the ones that have been heavily innovated upon. And there's not been a lot of innovation in checking, savings, debit cards, and mortgages. I think that as these get more competitive, like checking accounts are being, extremely competitive right now with the APYs, and the ability for people to switch is becoming much easier. I think that the stickiness will drop. I hope it stays around for a long time, because the clients that SoFi will end up having will continue to stay on for longer. But I actually just think that the total time that people will spend with one bank will end up shortening over time, because the switching costs will continue to fall. So primary bank offers all the functionality we need, 92%. I'm calling bogus. Have changed their 92% say they've got everything I need. 51% leave. It just doesn't even make any freaking sense. And also, just to point out here, with my lemon-shaped US thing here, there is also the highest percentage of people that are potentially looking or willing to change. Consumers are branching out. Okay. Well, an additional 17% are looking to switch. 17%. Sorry. The loyalty shifts somewhat for younger generations, where more than a quarter, 27% of those aged 18 to 25 have considered changing banks. Once again, even higher the lower that we get, or the younger that we get. I mean, I got a call today, a marketer from a large bank here in Canada, CIBC, and they were like, hey, we'll pay you a fee if you end up transferring over some money or opening up a checking account with us. I said, what's the account fees? They said, Tanner, like, you won't believe what we have. If you keep $4,000 in the account, no account fees. Or if you do 20 transactions a month, no account fees. I was like, wow, how generous you guys are. I'm making 5% right now, and they require no minimums, no like nothing with the current bank that I'm at right now. I mean, hell, Moomoo is paying me 6% right now on my uninvested cash in that brokerage. Like, come on now. I'm not playing around with the whole checking account. And by the way, because it's a checking account, they didn't even know that because I asked them, I was like, what's the APY? And they were like, it's a checking account, sir. I was like, bro, freaking I think the whole idea of a checking account and a savings account is so old school. It's going to be one account. And if you want multiple vaults, if you want multiple versions of different accounts, so then you can separate it based on your savings, that's perfectly fine. But the idea of like having one account that has less transaction rules or something like this, so then they can sort of have more secured deposits, so old school, it's going away. And I feel like, am I the only one seeing this? Jeez. Consumers seek a balance of trust, speed, and ease of use for managing the life cycle of their money. All right. Accelerated wage access. We've spoke about this already. I think that it's a hard time to be talking about it, but there was some pretty interesting statements that were said here. Some pretty crazy ones, actually, ones that I never thought that would be said. Anyway, more than 6 in 10 Americans live paycheck to paycheck and want more ways to take control of their finances. I always hear statements like this. It still blows me away. 6 in 10? Anyway, nearly a quarter, 24% of US consumers surveyed, a number of swells to over one. Sorry, the number swells to over 1 in 3 Americans, 18 to 34 years old, consider themselves a part of the gig economy. Okay. More than 3/4, 77% of that gig economy are living paycheck to paycheck. So, this is what they're saying. Everyone wants to get paid instantly. That number is extremely high in Australia and in the US and in general. Anyway, look at this though. 72% of Americans surveyed by Marqeta in June of 2023 between the ages of 18 to 50 years old said that the option to get paid immediately increases their interest in an employer. That number increased to 89% in 2024. In a single year, that went from 72 to 89%. What's more, 37% of all US consumers 18 to 34 said instant pay is a necessary benefit for their employer, above the 35% national average. 25. I can't even believe 25% of people saying, I will not accept a job offering if they are not going to give me instant payment. That blows me away. Does that not blow you guys away? They actually said some very positive things here. Accelerated wage access empowers employers and platforms to do both, all while creating new revenue streams. Yeah, that's what the regulators are not happy with. Anyway, spiking adoption amongst consumers between the ages of 18 and 34 promises to bring a tsunami of change in this area. As younger generations enter the shift/gig workforce, the demand for flexible digital financial solutions will rise. I don't know if you call YouTube like gig work or whatever, like it's, flexible. I'm on my own terms. They only pay once a month. It's like the opposite of flexible. At my current job right now, I get paid twice a week. That's flexible. Like not once a month, YouTube. Anyway, where the majority, 62%, frequently interact with their bank via the bank's mobile app. Oh, sorry. Majority of people end up dealing with their bank. This is digital-only bank usage. Sorry, I should have read the thing here. Anyway, just 17% of consumers say they visited a bank branch in the last 7 days. Go work, Bank of America and JP Morgan, continuing to invest in your biggest growth effort, the expansion of bank branches. 17% of people give a crap. Additionally, U.S. consumers are more willing than their counterparts to move all finances to a digital-only bank, while 18% said they would consider it, and 8 are already doing so. In the UK, the numbers are much higher. Anyway, the biggest draws to these banks include earned rewards like higher interest rates or cash incentives. Very much so. The APYs are definitely an important part. All right. Modern banking lives at the intersection of traditional and digital financial services. More than half, 60% of consumers keep more than half their money with their primary bank. Okay. Older generations skew in the opposite direction, tending to spread their money around. Now, this is my belief. I believe it's true, but I don't have any fact on it. So I can't say that this is a fact. But the greatest indicator of wealth is age. The older you are, the more likely you are to have more money. Okay? Or at least from a demographic perspective. So whenever looking at older generations, they're going to have a lot of savings that end up blowing way past FDIC or whatever country that you have that's similar with the amount of insurance that you can have to cover if the banks were to fail. So they have to spread that around. Now, a lot of the new fintechs and new things to do right now is to actually work with a bunch of different banks so then you can keep their primary bank in one area while increasing their FDIC insurance. So, for example, like SoFi, you can have $2 million of FDIC insurance, but still only have to be with one bank. Essentially, your money is being spread around, but you don't have to worry about that as a consumer. So, like, SoFi is looking at all the angles, the fintechs are looking at all the angles, and they're trying to say, hey, why would potentially people not keep all of their money at these banks? And how can we address those problems? When it comes to depositing funds, roughly 1/3 uses the bank's app, 35%, or they visit a physical branch, 35%. The latter is especially appealing to older consumers aged 65 plus, where more than half, 56%, prefer to visit the branch. The one thing that I also have to remind myself is that the older generation, although still having to appease them and service them, is that there's fewer of them every day. And the younger people, there's more of them every day. Well, I mean, that's not true because, like the people that we're looking at that are 34 and under will become 35 plus, but their habits will stay in the generations that they were raised on. So if they're on Venmo, they're still on Venmo even into their 50s, right? Or 65. Whatever they got learned on is most likely what they're going to stay on. But yeah. Comfort for non-traditional providers growing. Australian consumers prefer to make deposits at ATMs 28% more than the US at 21%. I've never made a deposit at an ATM. I'd be interested in hearing if you guys have. Anyway, the UK interacts with physical branches 40%, where the US 32% and Australia 35%. The US is leading for depositing funds using the bank's mobile apps. Good to know. Maybe for a special company that rhymes with FOFI. 1/3, 34% of consumers say that they wouldn't feel affected if all physical branch locations were closed. 34%. That's our target audience right there. Almost half in the US, 46%, store money outside of a bank as a precaution if something should happen to their bank. I could not believe this statistic. 46%? Like, what do they mean by store money? Do they mean like $2,000? Like, I mean, I've got some cash, but I'm not like diversifying against my bank. Or are they including cryptocurrencies and secure? Like, what do you mean? Because whenever I read that, I think like cash in a safe, in which I find that crazy. I have some cash in case of a disaster. Anyway. Still, the US is more tethered than others to in-person branch interactions, where with 1/5, 21% of consumers more often banking that way compared to the UK or Australia. Nearly 2/3, 62% of consumers in this year's survey said they would not consider getting financial services from non-traditional providers, a 30% jump from the 53% who said that they wouldn't consider it in our 2023 survey. Now, this is very interesting. This could be due to some problems very recently with some fallouts of different banks or, I mean, maybe the Synapse sort of story is a little bit early, but FTX or something like this might be in people's heads in terms of like, if you're not a traditional bank, that there could be some problems there. Maybe other examples that I'm not thinking of right now. Now, non-traditional providers, they're saying many consumers, 45%, view these entities as untrustworthy with money or personal data, which are major barriers to overcome. So think about this as well. I was thinking about this for like, what companies, if trust is the number one thing, are affected by this sort of, problem? Like, I think Meta, like Facebook, would have a severe problem. I think X would have a problem with that. I think even Robinhood to some degree because of what had happened. I wonder what percentage of consumers are looking at them saying, I wish I could use them, but also they have done me a disservice previously, you know? Consumer habits at the point of sale is another area where we can see small shifts towards modern alternatives. I thought that this was a great graph here. Um, Last times you've used each one of these payment types, debit cards, credit cards, we are using these every week. Cash, 60%, still very high. But we're starting to see some people saying never used. Mobile wallets, however, very interesting. So many, like such a high percentage, almost 40%, haven't even started using a mobile wallet. You know, very interesting. Um, Sorry, U.S. Usage mirrored the whole with 2/3 of consumers. Yeah, so they just the U.S. essentially fit directly into this sort of thing where Australia and UK maybe had a little bit of difference in terms of their percentages. You guys can pause and read through that if you'd like, but let's continue on here. Ease of use continues to be the single most motivating factor for consumers when choosing which card to use. Additionally, many expressed an aversion to being required to use a new app or payment method at checkout. Overall, slightly more shoppers are likely to comply, 44%, than to abandon a purchase, 38%, particularly US consumers, where nearly 47% of people would comply. Interesting. But uh, yeah, this is also pretty interesting. I thought a lot of people not really giving a crap about cash back and are looking for rewards. I wonder if SoFi, I'm kind of anti reward cards, but if SoFi ends up coming out with a reward style product, they just mimic the expense of a cash back card. But if more people are looking for rewards cards, why the heck would we not offer one? You know? Um, And then, yeah, let's talk about the payment space really quick because this is more for the PayPal viewers out there. This was very interesting. The payment space is evolving at a breakneck pace. While 44% of consumers say they don't care um, about more brands starting to offer financial services, the data also shows that rewards, convenience, trustworthiness, and ease of use are appealing to consumers. Okay, good experiences and feelings propel consumer loyalty, with more than 57% of consumers uh, reporting those are the reasons why they're loyal to their favorite brands. It is so fun. This is Nubank written all over it. There are other companies that can offer similar experiences or something along these lines, but they may do something, whether it's customer service or something along these lines, that just make people feel a certain way, right? And that completely adds to trust and loyalty because you got treated a way that you really respect. Another great company for that is also Costco and Starbucks. You also have to include Starbucks in there, where it's like just not even about the products or anything like this, but the way that they make you feel when you're there is such a reason to be loyal to those companies. Negative experiences can be just as impactful too. Consumers primarily deal with negative experiences with concern over how mistakes are addressed uh, and patience with the situation. So this is pretty interesting. A lot of young people say, they want to know how a situation is addressed, not necessarily that the actual problem has happened. I find that that's very funny too. There's a lot of people where something bad will happen and they will just be like, "Oh, I'm never using them again," as if, problems can't happen, where I find that older people are much more favorable to just say, "Yeah, bad things happen, but they gave me a $10 what was it? $10 Starbucks card? What was the gift card that CrowdStrike the freaking I got to find that story again. That was so funny. Someone put it in chat, please. Uh, Economic drivers are decreasing savings. The US and the UK have seen an increase in savings, however, Australia breaks that trend. And they also talk about one of the biggest wealth transfers in the United States history are coming, and banks must prepare to address the inevitable generational shift that will be occurring. I wonder who's going to win whenever that happens. Look at Robinhood, look at SoFi, look at a lot of the younger types of banks and brokerages that are going to try to win over users during that time. And yeah, anyway, I don't have much on the terms of the actual missed credit card payments. This was another thing too. Just they're finding people are so averse to fees and surcharges that they weren't expecting, and that they'll completely dodge those companies if those things end up happening. I think that's a big thing that people need to get their head around for big banks as well. It's like, why are you sticking around? They're gouging your eyes on these small little areas and just taking advantage of you. The rising power and relevance of peer-to-peer payment platforms. This is, Cash App, Venmo, Zelle, PayPal, these sort of ones, particularly amongst younger generations. Usage rates are the highest in the United States, with more than 3/4 or 77% using peer-to-peer platforms, and increasing the usage. Maybe 11% say they are decreasing their usage in peer-to-peer platforms, but most are increasing or staying the same. Remember, what falls into that bucket is people that use them all the time. It's hard to increase your usage. Cash App and Venmo have become household names, though PayPal continues to be the most popular peer-to-peer app, especially in the UK and Australia, where 97 and 94% of consumers have used the app. Respectively, Cash App is the second most popular peer-to-peer payment app in the United States, with 53% of consumers reporting that they've used it, compared to Venmo and Zelle all the way down to 39%. High peer-to-peer usage positions these payment apps as gateway services that could open the doors to other offerings. They're getting tapped for credit cards and debit cards, bill pay, all these other solutions. Debit cards at 62%, direct deposit 29%, checking 36%, savings 35%, credit cards 39%. Peer-to-peer apps are also, although being less frequently used, are getting used for cryptocurrency 11%, fractional stock purchases 5%, and charitable donations at 8%, really leaning towards PayPal on the charity side. But if you're not using one already, you should consider integrating your peer-to-peer payment systems into your offerings, whether that includes developing your own peer-to-peer solution or partnering with one of the established platforms. What does that remind you of? What did SoFi just do? That was it. That was the end of the report. But SoFi just got into bed with Zelle because users are hungry for it, and we got to give them what they want, and they'll be more sticky because of it. Tanner, you need to start looking at charts, and all that info you give doesn't help in a bear market, which we are in now. One bad day, we are officially in a bear market. That's actually not true, just so you're aware. A bear market is a 20% drawdown. That's not where we are. You can make assumptions that might be where we're going to be, but that's not true. What am I reading from? That was the Marqeta State of Payments 2024. They give some great insight into the themes of how people are actually using cash. Continue to look at fintech companies. You want some insight into where or if people are going to be downloading and continuously switching over to SoFi from their traditional banks. That's some of the best insight that you're going to get. People want to look at stock price, like this comment here, and not focus on the underlying company. I will continue to not listen to that advice. And in my opinion, I actually think that that's the wrong advice. I think that the way that people get to Warren Buffett status is by not freaking out. It's so easy in a way. I mean, I don't think that what he did was anything easy. But freaking out and selling your stocks or something like this, not based on fundamentals, but because I need to start looking at charts, is exactly the opposite way. I think that that's what every retail investor falls into, and that's how you're going to lose your shirt. Hold through the ups and the downs. It's fine. You ever hear DCA? I'm trying to find out what are the industries. Like, I had a conversation with Steve, like I said yesterday, but it was like an hour long. And he was telling me about how people cannot predict the future. Well, I mean, to some extent, I cannot predict the future like down to the number, but I can observe and make predictions on the trends that I believe are going to continue to happen. Right? Are data centers going to have more usage over time or less? Are EVs going to have more of the total pie of vehicles or less? Are people going to be using more cash or less? And you can make these sort of predictions and then invest over the long term. Tanner, I've been trading and investing for 68 years, and I'm trying being down on my shares and sold this market at highs. That's awesome. That's awesome. But I can't, successfully do that. And I think that probably 98% of people are not able to buy at lows and sell at highs. Traders, like, historically have done unbelievably terrible. Michael, if you've been doing that for 68 years, you're doing phenomenal. And, good on you. That's great. But charts aren't going to get me to where I want to be. Look for industries that will do better over time, and then buy those companies at good valuations. That's investing. I want to bring up Palantir here. I like what Palantir does. I love the products that they have. The only part that they don't fit into the bucket for me is the price. And they might get to a price where I think that they're affordable. And that could come two ways. The stock price could come down, or the actual fundamentals could rise up while the price of the stock stays stagnant. And then, I will end up seeing that the company is worth a buy. I think Robinhood recently did that, and that's why I bought it in the 16, 17 ranges. But if one of those two things don't fit, I'm not a buyer. Tanner, any thoughts on how we can extrapolate to Adyen? I mean, not a ton, but cashless society, definitely a benefit to Adyen. If that continues to be the next big thing, they're going to benefit greatly. Yeah. I've been doing it since 2008, hit many 10Xs. Biggest lesson is don't get emotional about stock and know when to let go of a stock when it's peaking. Rinse and repeat. Also, close eyes on. Cyclical nature of bull versus bear runs in the market, 7 to 10 year runs. So that's another thing that I worry about is like, do you think that the bear bull runs are going to significantly decrease in the times that those markets take to, like, from peak to trough, because the frequency of trading is increasing so much? Yeah, I mean, I've been reading on some things about technical analysis just to add to my belt in terms of whenever I'm going to buy, but I'm not looking to buy many fintech companies right now. I mean, My portfolio is heavy, you know. I'm just acquiring now. Or sorry, I'm not even acquiring. I'm just holding right now. I'm new to your channel. Do you feel like SoFi is undervalued at the price it's currently at as opposed to Robinhood? I would say I like SoFi more at this price. I own both companies. SoFi so much more than Robinhood, but they're, in my belief, they're both going to go up. It's not a sort of a recommendation in terms of what to buy, though. I mean, this is just how I see the companies. I think that lending is going to have an amazing roadmap going forward, and they also have such a track record for doing what they've done. Robinhood, while I do believe that they are going to do unbelievably in terms of capturing the young audience and that wealth transfer coming down, and they're going to see massive increases in assets under custody, there are going to be bumps along the road of whether they are being too aggressive in their growth strategy. They are offering a pretty aggressive credit card we're not certain if it's going to work out. They're new to lending. So there's a concern there. We're flipping, if interest rates start to get cut, from a lot of interest revenue being earned to a lot of transaction revenue being earned. How is Robinhood going to do during that transition? We don't know, right? Historically, like whenever interest rates ran up, they had a very, very freaking hard time. Is it going to be the same on the way down? I don't know. I also own SoFi and Hood, my only fintech stocks. Gotcha. Well, welcome to the channel, my friend. Yeah, I mean, I'm not trying to say that. Oh, guys, ladies and gentlemen. Okay, wait. One quick story. I can't keep asking questions. I'm so over my time right now. One last story that we did not get into, which is Bank of America issuing a common stock dividend increase of 8% to 26 cents per share and authorizes a $25 billion stock repurchase program. I'm saying if they just, instead of doing this, acquired SoFi, right, made a bid for SoFi. I'm not even saying that they would even be able to capture it at that price, but made a bid. I think that stock would be a lot worth a lot more. Right? You're taking out one of your key future competitors, and not only that, you're actually benefiting from them. But no, they continue to invest in themselves. I think that this is exactly what is wrong with the legacy banks. Is as big as you are, as many hundreds of billions, trillions of dollars that you have, you can only grow based on the percentage of growth that you have versus your total mountain that you're sitting on. Okay, and with that less capital that you're giving to shareholders or investing in branches, if you make the wrong plays, you are not going to grow as fast as the other competitors in that total addressable market. If B of A buys SoFi, I am out. Well, yeah, that's how that works. You may be given cash or you may be given shares of B of A, but that's how that works. Yeah, it would be like if they acquired them. What's up, TJ? Good to see you, man. I was watching this show recently. I don't understand half the shit that you guys are talking about, but it's something that I'm going to be starting to learn now. Now that I have a brokerage that can actually do level 1 options. Okay. Ladies and gentlemen, I got to get going though. I really do appreciate your time. I am doing all of the earnings speed ups, man. Your time in the market. I mean, I agree, but I also like that's just general market. I do think that there's going to be lots of growth. We'll talk about that another day. All right. So, no, I can't come on sometime. TJ, I wouldn't be able to add to the conversation at all. Okay, but I'm doing all the earnings calls for all of the large fintechs and then doing recap videos on them as well. Hopefully, you guys hit the subscribe button, hit the like button, whatever you want to do to keep in touch. But until tomorrow, bye for now.